Good morning. Thank you, Dan. Let me extend a very warm welcome to central bankers, both from abroad and my colleagues from the Central Bank of Sri Lanka, commercial bankers, representatives from other financial institutions, as well as cash management and cash in transit companies, staff of currency research, and our sponsors. It is a great pleasure to be here with you this morning, and thank you very much for inviting me. A special word of thanks to Dan in particular and his team. You heard from Dan the very scrupulous due diligence he undertook after the very unfortunate and heinous events of April. And we're pleased that he stayed the course and made sure that this event took place as it is now taking place over the next few days. And we are particularly grateful also to all of you who come from abroad. I believe there are 34 countries represented amongst the participants. And we are deeply grateful to you that you are here as a mark of support for the country and the people of Sri Lanka. And of course, we in the Central Bank of Sri Lanka are particularly grateful to you for coming here to join us for this important event. Now, this is the first time. I mean, before I go on, one thing is when you're in my position, it's too tempting not to give a plug for the economy, and so I'm going to take a few minutes to tell you a little bit about what's happening in the Sri Lankan economy, and to try to persuade you that it is stable and that the prospects for the future are very bright indeed. Why do I say it is stable? Our inflation is now around 4%, which is at the bottom end of our 4 to 6% inflation target. The current account deficit is expected to be about 2.6% of GDP, which we think we can fund in a sustainable fashion. Our reserves are about $7.8 billion, which is about 4.5 months import cover, which is reasonably comfortable. And all this has been done despite the fact that we had these terrible events in April, which actually struck a very severe blow to the economy as a whole and the tourism ecosystem in particular. But despite that, because the macroeconomic policies have been sound, the economy has been able to absorb this shock without any major crisis. Certainly, there have been some adverse effects, but we seem to be working our way through those. And the economy remains, the fundamentals of the economy remain basically sound. On the growth side, certainly growth is below potential at about 3%. We think the potential growth rate is about 5%. And once we get through the electoral cycle that we are in, I'm confident that by the second half of next year, we will be moving up towards that potential growth rate. And the overall potential of the country is also considerable for the following reasons. One is location. We are located about less than 20 miles off the coast of the Indian economy, which has been the fastest growing large economy in the world, though it has slowed down a little bit in recent times. But there is that market of 1.2 billion people, particularly the 5 southern states, which have been growing at 8% plus for a number of years now. We're smack bang in the middle of China's maritime Silk Route in the One Belt, One Road initiative. If you look at it, we are right in the middle. We have access to ASEAN on one side, the Middle East and East Africa on the other. We are in the middle of the time zone between Europe and the Far East. So there are enormous advantages to Sri Lanka's location. And we have excellent international relations with everybody. So the location, the good relations, the fact that we have a well-educated population, and the fact that the macroeconomic fundamentals are in pretty reasonable shape, makes us fairly optimistic about the future. So that's a little plug for the Sri Lankan economy. And the other thing one needs to say is that the economy and the people of Sri Lanka have shown great resilience over the years. We came through a 26-year conflict in our country. The economy went through that. The people went through that. We had this shock in April. We are coming through that. So at each turn, the economy has shown significant resilience, and the people have shown great resilience. So this is what makes us very optimistic about the future. And we've got a few elections to get through in the coming months. And we got universal franchise way back in the 1930s. And we've been independent since 1970, and there hasn't been a single day where an undemocratic government has ruled this country. So we are very proud of our democratic history, and we think our economy is resilient and has great potential. So that's us, that's Sri Lanka. So let me now get down to the business of this event. This is the first time that the Central Bank of Sri Lanka is hosting a currency-related international program. It is also the first time in the 24-year history of this seminar that it is taking place in South Asia. We are glad that Currency Research decided to proceed with conducting this seminar in Sri Lanka. As you have observed firsthand, normalcy has been restored fully after the unfortunate incidents of April this year. I'm sorry we haven't been able to fix the weather better for you, but otherwise things are very normal. And I'd like to reiterate that we're thankful to Dan for staying the course and demonstrating faith in our ability to host this event. My colleagues are doing everything possible to justify this faith in us in terms of our capacity to deliver this event. And I'm sure by the time you leave, I think you will be happy that you made the decision to come. Now, as I said again, we also appreciate the presence of all the participants from the other 34 countries as a mark of their support for the Central Bank and for Sri Lanka and its people. Now, the history of this event, as you are more aware than I am, the Cash Cycle Seminar is a global seminar for commercial cash management, distribution, and circulation. It is organized by Currency Research, and CR has undertaken research and consulting projects to promote a deeper understanding of currency operations and management, as well as payment industry issues, in order to equip industry stakeholders with the most up-to-date information on trends, strategies, solutions, services, and technologies. This unique event brings together the main service and machine suppliers of the currency and payment-related industries, and the users, namely central banks, commercial banks, and cash handling companies from across the globe under one roof, thereby providing a unique platform for a free exchange of views and ideas on cost-saving technologies, strategies, and best practices. It is also an opportunity to showcase the rapidly changing technological advances in the alternative mode of payment methodologies. Currency Research has also conducted regional seminars in the Americas, Asia, Europe, and the Middle East, as well as Africa. This is the 10th annual Asia Cash Cycle Seminar. Your theme this year, Strategies and Innovations in the Cash Cycle, is particularly pertinent and timely. You have a very full and topical agenda. Let me address a few remarks on each of the issues that are to be discussed. As for the cash and payments landscape in Sri Lanka, the Central Bank has the sole right and authority to issue currency, which is the legal tender in Sri Lanka. The Currency Department of the Central Bank carries out functions relating to this statutory responsibility. Despite the efforts to move to a less cash society, physical currency usage has been recording significant growth during the last 5 years, as indicated by a 13.7% average annual growth of currency in circulation during the period 2013 to 2018. The Payments and Settlements Department of the Central Bank of Sri Lanka is working continuously with stakeholders such as Lanka Clear Private Limited and licensed financial institutions to promote non-cash payment methodologies by promoting innovative technologies through our cash cycle partners. The launching of the National Payment Switch and Common Card and Payment Switch in 2013 marked key milestones in the evolution of Sri Lanka's electronic retail payments infrastructure. In fact, the former Deputy Governor who was very much involved in this, Dr. Jamha, is here and will be speaking to you later in the day. The Common Card and Payment Switch is a multi-switch retail payment infrastructure that comprises 5 sub-switches. 1, the common ATM switch. 2, the common electronic fund transfer switch. 3, the shared ATM switch. 4, the common POS switch. And 5, the common mobile switch. More details of the cash and payments landscape will be presented to you by the Superintendent of Currency and the Director of the Payments and Settlements Department of the Central Bank during the course of this morning. The cash industry is clearly undergoing significant transition. Physical currency issued by central banks is still the most widely used form of payment in all regions of the world. There is clear evidence that currency in circulation is growing, both in absolute terms and relative to GDP. Currency in circulation relative to GDP has increased to 9.6% across all continents, up from 8.1% in 2011. However, there are significant differences in the trends in cash usage across continents and countries. Asia, Africa, and Latin America appear more reliant on cash, while North America, Oceania, and Europe are reducing their cash dependency. Asia has experienced generally healthy growth for cash usage due to different drivers such as buoyant economic performance, trade growth, rising income levels, and population growth. There are a few countries that are experiencing a decline in cash usage. These include Sweden, Norway, New Zealand, and Canada. The key driver has been the rapid adoption of the developments and improvements in new fintech and payment technologies. Innovation is being boosted by strategies that change the retail payment system. This is leading to an increasing volume of card payments, adoption of mobile and internet payments, adoption of a national QR code and national payment card, the emergence of contactless payments, and an integration of electronic payment functionality directly from social media platforms, enhancing the ease of card use as well as mobile payments, virtual currencies, and instant payments. And of course, there is the common ATM switch as well. Becoming a less cash country is a long journey, which has to be driven by various factors, such as a collaborative approach among all stakeholders of the cash cycle and payment system, a supportive legal framework, strong internet and telecommunication infrastructure, popular mobile payment applications, and a reduction of the cultural mistrust of cashless transactions. What about digital currencies? Innovative technologies are offering a complementary approach for the development of virtual currencies or private digital currencies. A rapid rise and spread of fintech is compelling central banks to monitor and analyze their implications. A digital currency allows two users to exchange value digitally without the need for an intermediary. Central banks so far have been very wary and cautious about allowing these types of transactions. There seems to be a more accommodative approach to e-fiat currencies or central bank digital currencies. However, here again, there is still caution pending greater study and understanding. However, we have seen some progress. Sweden, Denmark, and Norway have already established the relevant infrastructure and legal framework to issue CBDCs, and Canada and Singapore are ready for partial implementation. Central banks have outlined some of the issues regarding the implementation of CBDCs, as they have huge operational consequences and implications in implementing monetary policy and in achieving the twin objectives of price and financial system stability. What about digitalization and resilience? On this subject, the main concerns or vulnerabilities are security breaches, unauthorized access, and data protection, i.e. cybersecurity concerns around the use of non-cash payment methods. Physical infrastructure resilience is also very important for reliable digital transactions. Failure or non-availability of physical infrastructure such as electricity, telecommunications, and high-speed internet facilities directly affect people's trust in the reliability and safety of digital payment methods. These failures can result in financial disaster and reputational losses for the public, merchants, and financial institutions. On speeding up the cash cycle and lowering the cost of cash operations. Currency management and operations are the single most expensive item in central bank budgets, as they constitute a huge involvement with cash processing, recirculation, and storage, in addition to the printing and minting of currency notes and coins. This places a very high premium on collaborative efforts among the cash cycle partners to lower the cost of cash operations. Commercial banks and cash-in-transit companies should provide committed support to central banks in this endeavor. With that, let me conclude by wishing all of you very successful deliberations over the next couple of days. And again, to thank all of you very much for coming to attend this seminar. And those of you who come from abroad, a very special thank you once again. Thank you.